Finally, the fifth internal control component that the auditors must understand is that of the methods used to monitor the internal control performance over time. The client should have procedures in place to assess the design and operation of the controls on a timely basis and to take corrective action. Examples of monitoring activities include reacting to customer complaints, examining regulatory comments such as the SEC reviews, and using internal reports to compare and question situations where the actual results are different than anticipated. CPA candidates, it is very important that you can list and discuss the 5 internal control components. Also, don't lose sight of the big picture. The auditor is required to understand the internal control process, which involves the 5 internal control components of control environment, risk assessment, control activities, information and communication, and monitoring. Also recall that there is a direct relationship between the control components and management's objectives of reliable financial reporting, effective and efficient operations, and compliance with laws and regulations. What tools do auditors use to document their understanding of the control process? Auditors utilize one or more of the following: a flowchart, a narrative memorandum, an internal control questionnaire, and/or a decision table. Of course, the form and extent of the documentation depends on the size of the organization being audited, the complexity of the audit, and the nature of the entity's internal controls. The general rule is, the more complex the internal control process, the more extensive the documentation. Please consult the Wiley CPA Examination Review for examples of flowchart questions, internal control questionnaires, and memorandums. Typically, the CPA exam does not ask a candidate to prepare a flowchart. Rather, the candidate must know symbols to identify missing controls and symbols. The exam has required candidates to prepare a questionnaire from scratch for a particular transaction cycle. A very typical essay question requires candidates to read a narrative memo and discuss the weaknesses or reportable conditions in the system. The only way to learn these concepts is to practice using previous exam questions. Later in this CD, I will identify some of the major controls for a few key transaction cycles. However, a CD does not provide enough information to learn the relevant concepts. Please work previous exam questions similar to those contained in the Wiley CPA Examination Review text. For product ordering information, consult the Wiley website at www.wiley.com/CPA. Can you recall the important exam phrases for Step 1, understanding the client's internal control? During the understanding phase, the auditor is looking to see if the client is using internal controls, and if the client has placed controls in operation and has designed internal controls. Using controls, placed controls in operation, and designing controls are key elements in understanding the client's internal controls. Once the auditor documents the understanding via a flowchart, memorandum, questionnaire, or decision table, the auditor then moves on to Step 2 of the internal control process to assess the control risk. Step 2 of the internal control process is that of assessing the control risk. Control risk is defined as the risk that a material misstatement could occur in an assertion that would not be prevented or detected on a timely basis by the internal controls. The definition of the assessed level of control risk is the level of control risk that the auditor uses in determining the acceptable level of detection risk to accept for a financial statement assertion. Wow! What does this mean? Management makes assertions in the financial statements. As covered in Module 3, Audit Evidence, there are 5 groups of financial statement assertions. 1. Presentation and disclosure. 2. Existence and occurrence. 3. Rights and obligations. 4. Completeness. And 5. Valuation and allocation. When management hands the financial statements over to the auditor, they are asserting the above 5 things. For example, management is asserting that their financial statements present the accounts receivable in the proper place, balance sheet, as a current asset, usually listed after cash and marketable securities, with adequate footnote disclosures that the receivables exist, that the client has the right to collect the receivable, that all receivable transactions have been recorded and are complete, and that the receivables are properly valued at the net realizable value. Auditors must determine at what level of control risk they can accept that all of the financial statement assertions have been properly considered. For example, if there is a great risk that the internal control process is weak and will allow receivables to be presented on the balance sheet that don't even belong to the client, then the control risk over receivables for the rights assertion would be assessed as high. Actually, instead of saying that the auditors assess control risk as high, they say they assess control risk at the maximum level. This means that there is a great chance that the entity's internal control process will not prevent or detect a material overstatement on the financial statements of the receivables that don't even belong to the entity. Auditors hope that the client's internal controls will support an assessment of below maximum risk. When an auditor assesses control risk below maximum, they are indicating that the controls are operating effectively to help prevent or detect material misstatements. When controls are operating effectively, the auditor can reduce the amount of substantive tests that they perform on the account balances. It is very important to see that auditors must link or relate their assessment of the client's internal controls to one or more financial statement assertion. The auditor's primary concern is whether the internal controls affect a financial statement assertion. Now pay attention here. After auditors understand the controls, they make an assessment as to whether or not the controls could support a risk assessment of below maximum. Let's say a client has no internal controls. Then what? Document your understanding of the controls and assess control risk at maximum. Forget about going on to step 3 to perform test of controls. There are no controls to test. Simply document your understanding of the control process, assess control risk at maximum, and increase the amount of substantive tests. In fact, you would not only increase the amount of substantive tests, but also perform the tests closer to the balance sheet date and gather more outside, third-party evidence to support the account balances that you are auditing. When the control risk is assessed at maximum, just document the understanding of the controls and the maximum assessment. When the control risk is assessed at below maximum, document not only the understanding and the assessment at below maximum, but also document the basis for the conclusion. What would lead you, the auditor, to the conclusion that the control risk was below maximum? Can you think of what would serve as the basis to conclude that the control risk should be assessed below maximum? The conclusion is based upon the results of the tests of controls. In fact, auditors are precluded from assessing control risk below maximum unless they prove that the controls are operating effectively. Are tests of controls really optional tests? While auditors are never required to perform tests of controls, they are required to perform them if they desire to assess control risk below maximum. If you don't perform tests of controls, you must assess control risk at maximum. Increase the extent of substantive tests of the account balances, the tests of details and analytical procedures, and perform the tests closer to the balance sheet date and gather more outside third-party evidence. If an auditor finds that the client has little or no controls, assess control risk at maximum and skip the tests of controls.